Wondering, as a tech investor, what you make of what we've witnessed with the NASDAQ and that sector over the last few days. Is this a simple correction, or is it something more?
Well, you probably saw last night, Scott, I tweeted, pullback, what pullback? Let's just ground this in some facts. Even before today, pre-COVID, the multiple on our software growth index was about 10 times sales. It peaked about a week ago at 15 times sales. Today, we're at 13 times sales. So we're still 30% higher valuations on a multiple basis in software than we were before the pandemic. The same is true for growth internet. Pre-COVID, we're about 23 times next year's EBITDA. We peaked at about 35 times next year's EBITDA. And today, we're still at 32 times next year's EBITDA. So hardly a correction in my book.
Well, I mean, do you think it gets worse? And does it need to get worse? Do you think that some of these stocks got simply out of control in the way they went up parabolically?
Well, the characterization doesn't need to get worse. I mean, it's pretty good. These are peak multiples for internet and software stocks in the middle of a global pandemic. And remember, for most software companies, the pandemic has not accelerated their revenues, right? There are certain companies, Shopify, Zoom, certain e-commerce companies where we've seen tremendous acceleration, and so an expansion of the multiple is justified. But we've seen an expansion of multiple for the entire sector, many of whom did not benefit from COVID.
Do you think, I mean, look, if people scrutinize these stocks and the run-ups, they say it was built almost solely on multiple expansion, right? That suggests to you that it wasn't fundamentally driven, and that some of the air, there's still a fair amount of air that needs to come out of the balloon, if you will, in certain pockets of technology.
Well, Scott, I would take the other side of that bear case as well. Clearly, there's been digital acceleration in the behavior of people that I think will have some semi-permanence to it. The rate at which enterprises are going to move into the cloud has accelerated, and so it's logical that analysts are looking at their forecasts and saying we're probably too low in the out years in terms of growth rates. The same is true for e-commerce. But markets move quickly. It probably got ahead of itself a bit. We're at peak multiples. And so it would be logical in a world where we're starting to talk about vaccines that we see some money moving out of these high growth sectors back into more traditional areas of the economy.
How are you feeling about, say, your Facebook holding? It's your number one holding still, I believe. I'm also told you added to Microsoft in the last month or so. How are you feeling about those large mega cap technology stocks that you own today?
Yeah, Scott, as you know, we've owned Facebook for years, Uber's for years, Snowflake for years. We're long-term investors. And so, certainly some of those multiples are more demanding today than they were 120 days ago. I would be lying if I didn't say the rate at which prices and information has changed has been as fast as I've seen in my career. But with that said, our price targets when we look 2 or 3 years out for Facebook, for Uber, for companies like Snowflake are significantly higher than where they're trading today. And so we're not making many adjustments to the portfolio.
Yeah.